Well, I appreciate you guys coming out again. You could be doing a lot of things on a Wednesday night. It's nice and warm. This is a real nice summer day. Hopefully it's like this all the way through 4th of July.
Right.
So I appreciate you guys coming out here to our office here in the Kono district of downtown Oakland. And if you don't know, just kind of a plug for the district, from Telegraph Avenue from 20th to 34th Street is now called Kono. It stands for Koreatown Northgate. It's a new neighborhood. It's deemed a neighborhood last year. So we're only a year old, new district, new neighborhood. We have a special assessment tax that goes along with that. So if you are doing any shopping, we don't really have a lot of shopping places, but if you're going out for dinner, look for something in Kono, helps out. We're all trying to band together as business owners down here, bring more companies to this area. So we appreciate you guys coming down. What I'm going to do, and by the way, my name is Steve Peterson. I'm the broker owner of Infinity Investments. It's our company here, a commercial real estate brokerage and investment firm. We specialize in multifamily properties, but we do all types. Single families, office, retail, you name it. Our focus is multifamily. So what I'm going to do is I'm going to go into my traditional presentation where I talk about really the fundamentals. And so there's a couple of you veteran investors in here. That's going to be real ABC stuff. At the end of my traditional presentation, then I'm going to kind of talk to you guys about the special topic of the day, which is really getting your offer accepted. And again, I'll go into a couple of strategies that will help the odds, help your chances. There's no magic formula. It just doesn't exist. You want to do everything you can to set yourself up for success. So I'll talk about that at the end of the presentation in more of a conversational style. So with that being said, if you have a burning question, ask it. If you can hold off to the end of the presentation, that would be better just in terms of time. So, just like a little background on the company. We started the company in November 2009. I was working at Sotheby's at the time in Montclair. Just, thought it was time for a change. The market was really depressed in 2009. Anybody remember 2009? If you're in the, okay, you guys remember how it was. I thought it was an opportunity though to start a company because there was a lot of blood on the streets, right? And there was actually a lot of properties available, completely reverse of today, right? Now you go on MLS, you only see a couple of REO properties. In those days, 90% of the market was REO properties. So things was flip-flop a little bit. So at that point in time, I had a couple of good clients. They were buying apartment buildings, so I split off. I did my own thing. So here we are. We moved into this location in August of last year from our location in Jack London. So it's been a very challenging last 4 years almost, but it's been very fruitful, and we're excited about this summer, this year, and the rest of the future of real estate. And I think it's very, very important for us to focus on the fundamentals. We're starting to go in an upswing of the market, so we don't want to get crazy like before. We need to stay focused on the bottom line. We need to stay focused on true investment principles. So I have to kind of brunt of what I'll be talking about tonight is how do we make sure that we're profitable, not just buying real estate or acquiring real estate, but we're building profitable assets into our portfolio. Okay. So what we do within the scope of brokerage is that we broker property, we buy and sell. We also syndicate, which is a word for putting together small groups, sometimes large, but we do small groups of people to acquire property, and we manage property as well. So we try to be a little bit unique in a traditional brokerage firm as opposed to just selling property. We wanted to get involved in the ownership of the asset. So that's our unique value proposition in terms of how we not only trying to sell property, we're also trying to build wealth. And I hope you guys will be interested in doing the same, whether you're looking to acquire properties individually or with friends or whatever. Focus on building wealth and not just buying a property or flipping a house, okay? That's critical, I think. Now, before I go into the details of the fundamentals, let's talk product type. Product type in real estate, this is the food groups of real estate, right? You've got your single family house, condos, townhouses, 2 to 4 units, what's called residential income, okay? Once you go 5+ units, that's multi-family property. And in commercial real estate, a lot of people will call it residential. If you have an apartment building, But in actuality, if you have 5 units, that's commercial real estate. The reason is because you have to get a commercial loan. And the laws surrounding that property are the commercial laws. It's no longer a consumer product. When you're 2 to 4 units or single family house, you're in the consumer category. Once you go 5 plus, you can't go and get a residential loan. You have to get a commercial loan. So understand that distinction. Fundamentals is the same, but there is a specific distinction, especially as it relates to when you have to go get a loan. All right. Within commercial, you got retail, office, hospitality, that's hotel, motel, industrial, special purpose, that's like a church or a coliseum, a stadium, something like that. And the list goes on and on. So these are the basic food groups. We focus on multifamily. You guys, what I would say is you can make money doing anything. I'm sure there's guys out there. I just talked to somebody last week. I think I had a couple conversations last week about a guy who's doing really well in manufactured homes, and not the individual homes, but like the parks, you know, the mobile home parks. So that's what he does. He's doing really well. So figure out what works best for you. We like multifamily, and here's why we like multifamily. First of all, there's a stable cash flow during the holding period. Okay, holding period being the time you own it, right? What I mean by stable, and this is everything, all things considered, right? You still need to have good management. You can take a good property in a good location and run it into the ground if you don't know what you're doing. All things considered, you're going to have a stable cash flow relative to the other property food groups. For instance, when the market crashed in 07, 08, there was a lot of vacancy. There was a lot of vacancy within single family homes. You guys notice that? You drive in there, even in nice neighborhoods. You drive a neighborhood and you see 3 or 4 homes vacant. You know, what's going on with that? And I know people want to live. What's going on with those vacant houses? REOs, banks taking them back, so on and so forth. And retail property may have got hit the hardest in terms of vacant, because those are directly, you know, retail properties house businesses that sell to consumers. So the retail market was really, really hit hard. So was office, so was everything. So was multifamily. But multifamily outperformed the other classes because of the economics. People still need to live somewhere. And when people are losing their houses, 9 times out of 10 they're going to move into an apartment. They may move into another house for rent. That's true. But a lot of people are going to move into apartments. So even in the worst part of the market, apartment occupancy levels were higher than any other food group in real estate. So it's proven itself through the storm, if you will. And that's why we like apartments. Also, there's a nice economy of scale. And I'm kind of jumping around the bullets here, but here's what I mean by that. If you have a single family house, when you have it rented out, it's 100% occupied. When the single family house, when that tenant needs to move for whatever reason, they might be a great tenant, great tenant to move sometimes. But when they move out, it's 100% vacant. So at that point, until you get another tenant move in, you're not collecting any income. If you've got a 4-unit building, somebody moves out, you got rents coming in from 3 other people. So at least you're able to handle the bills, handle the mortgage, and sustain. If you don't pay your cards right, if it gets stuck in the bad loan market, you got a single family that goes vacant, you could be stuck with 2 or 3 or 4 months of payments coming out of your pocket. You know, so just understand that, be aware of that. If you buy single family homes for rentals, main thing you should do is just make sure you got a couple, 3 months of reserve. Single family homes are going to rent out quick if you price them right, but just understand that you might have to go through a couple months of no income. So that's part of the benefit of multifamily properties. And then also, as it relates to retail or office properties, you're renting out to people and their families. It's a lot more difficult to rent out to a company because you got to find that company. Now, in retrospect, there's some people who would say the latter. They rather rent out to companies because that's the business they're in. But just in general, if you as an investor have a property, you're probably going to have an easier time renting out your apartment than your retail space. And I'll just tell you, so we bought this property last April, and the front looks vacant, but there's a tenant who signed the lease. They go in, hopefully in and around August, September. But it took us a long time to find this tenant, several months. Whereas I don't even know if we have any vacant apartment units in our property, the properties that we manage. I don't think we have any vacancies right now. So it's very, when you're out to rent units in apartments, they're easier to rent. Right now, we've got people, we don't even have our sign yet for, we've been here almost a year, we don't have a sign, right? So I'm working on that. But we have people, 3 people in the last 4 days have walked in our office looking for an apartment to rent. And so that just, here's the street that's telling me something. So just that's part of why we like apartment buildings. There's a whole lot of other reasons. I talk about it's a great way to build wealth. And here's another thing. It's a great way to preserve wealth. We've seen a lot of cash transactions in real estate. A lot of people with cash are saying, where am I going to put my money? Am I going to put it in the bank? Am I going to put it in bonds? What am I going to do with it? So what's happening is a lot of people are saying, let me put my money in real estate. Particularly, let me put my money in units. Pay cash for it so I don't have any debt, right? There's no mortgage risk. And they figure over a period of time it's going to grow, it's going to outperform a lot of the different markets. But it's also going to generate income. And it's going to usually generate income at a higher rate of return than just about anything else. If you know what you're doing in the stock market, you might be able to make a higher annual yield. But you really got to know what you're doing. A lot of people don't have that expertise, so it's pretty simple to go out and rent out apartment units. You can hire a manager to do it for you. So it's a great way to build wealth. It's a great way to preserve wealth. It's a great way to beat out or to weather the storm if and when the market crashes again. And I say when because I think it is going to happen. It always does. It's just a matter of when. So we don't know. Nobody has a crystal ball right now. It looks like we're going to be swinging up for the next few years. But whatever you do it with the idea of what happens if the sky falls again, right? So that you can weather the storm. I've got several clients. I'll tell you about a client. He sold all his buildings in 2007. He had a lot of them. Came out with about $8-9 million. He paid the tax. He did not 1031 exchange. In 2009, I connected with him to start selling apartment buildings. Since 2009, he's done very well. He's made $10 million in equity and cash. He sold one of his buildings, but he now has 350 units in open. He sold everything, so he didn't start from zero. But in 2009, he didn't have anything except for a pile of cash. He started buying up. Now he's got over 300 units in the city of Oakland. And so and Oakland's a good place to have units. So it's just about timing, right? He didn't have a crystal ball, but he stopped buying things in 2007 when he couldn't buy anything else, right? When he was getting outbid and things didn't make any sense. And so he saw things. So that's what I'm talking about when we're focusing on fundamentals. You're going to be able to see shifts in the market. You're going to be able to see things happening before the market does. You ain't going to have a crystal ball, but at least you'll have a sense of what's going on and a fundamental understanding of what's a good investment and what's not. So here are a few things that we look at when we're evaluating opportunities. Number one is cash flow, right? Even in the market, even in the Bay Area, where the cash flow, the percentage of cash flow is relatively low, you still want a property. If you're going to buy the property for the purpose of owning it and receiving income, you want to make sure that it's cash flow positive, right? You don't want to buy an income property that you have to pay for every month, right? So you got to look and make sure the property generates cash flow. Number two, you want to look at what we call the NOI details, the net operating income, and the details around that. I'll go into what that is and why that's important, but you want to know what your net operating is going into a property and what your potential is when you own it. That's critical. Also, the price and the cap rate. Cap rate stands for capitalization rate. I'll go into that further in the presentation, explain what that means. But that's really, that's your value measures to whether this property is below market, above market. Where is the price of the property you're looking at to acquire in relationship with the rest of the market? That's the price of cap rate. Then we're looking at something called the rent roll. Anybody heard of the rent roll before? It's a simple thing. All it is a list of all the tenants in your building, move in, move out dates, how much rent they're paying, are they in a 12-month lease, month to month. It shows you what's going on with the tenants in the property. Critical for any type of property. Then finally we're looking at what's called the cash on cash return. That's the measure of the rate of return of the capital you invest. It sounds like a lot. I'll break it down simply so y'all can understand it. But it's a measure of performance, right? So it's like a batting average. If you watch baseball or a shooting average, or if football completion average. It's just a measure of performance. Just the higher, the better when you're looking at your cash on cash return. So these are key indicators that we're looking at. We advise you to do the same when you're out looking at property. So this will help you to understand, you know, what you're doing. So you don't want to just, it's getting crazy again, you guys. We got to operate, you know, with some fundamentals so we don't get caught up in it. It's very, very easy to get caught up in the hysteria. We just put a property on the market as part of a bankruptcy case. It's a commercial, it's a mixed-use duplex. Put it on the market last week for $350. We just went into contract today for $355. We had 5 offers, 3 of them at or above the asking price. And the property needs to be, the foundation needs to get rebuilt. The upstairs is caving in. It's a tough property. But 3 of the offers were for all cash. So what I'm saying here is it's starting to get crazy again. So there's more the reason for us to focus and not get caught up in that craziness. And sometimes that means you're going to have to walk on something that looks really good, or you're going to have to wait on something for a long time because it's really good. But don't get caught up in the hype. And the way to do that is just stay focused on the fundamentals. So where it all starts in an income property or investment property is the income. When you're analyzing something, start with that. And when you're looking at property's income, you want to start with what's called the gross scheduled rents. That is, the gross scheduled rents is the 100% potential rent for a building. Basically, it means the rent you would receive if everything was rented out and everybody paid, right? So that's kind of a la-la land. You start with that, and then you start coming down. You take away from that vacancy, all right? So each building's going to have a vacancy rate, but each market's going to have a vacancy rate. And even within a market like Oakland, the vacancy rate is going to vary. So by the lake, I don't even know that there's a vacancy by the lake, right? It's very, very difficult to find a property. I'm sure there's some vacancy. Somebody moves out. Somebody needs to rent out an apartment, so there's an opening. But very rare to find an apartment by the lake. Now, you go out to East Oakland, also difficult to find an apartment, but you'll have a few more openings, right? So within Oakland itself, the lake may have an average of 1 to 2% vacancy, whereas East Oakland probably about 4 to 5% vacancy. But I know several property owners in East Oakland, myself included, who have 0 vacancy, right? So a building may be 100% occupied, you still need to know what's going on with the market, right? And then budget that in. Even if your building is 100% occupied, budget in the market vacancy so you have room, you have a buffer zone. You have room if somebody moves out or somebody don't pay you. So then you take away loss to lease and concessions. So this is loss to lease is cost, you know, sometimes you have to give concessions for people to move in, first month free, $99 deposit. And I haven't seen that stuff here in a long time. In Sacramento a couple years ago, that was still happening. Even in Sacramento, that has pretty much started to go away. But there's things you have to do sometimes to get a lease. And then sometimes people aren't going to pay you. So you take that away, and you can analyze that on the existing property by looking at their rent roll and comparing that with their profit and loss statement. And so that's how you can kind of come up with either they're giving away free rent, either somebody's not paying, or there's some sort of, you know, loss to the lease that happens. There's some sort of rent credit, something. And you can analyze that by looking at their actual profit and loss and the rent roll and kind of comparing the two and seeing what's the actual income and what was the projected rent, or what should they be bringing in based on their rent roll, okay? So that, you know, so that's what you take away from your scheduled rents. Then you add other income. So this is laundry. The most common are laundry and vending. Also, in some properties, you're going to have billboard income, cable contracts. Some buildings have a contract with Comcast. So each person that signs up on Comcast, the landlord gets $10, something like that. That's additional income. You add that, right? You take away vacancy, but you add other income. That gets you a bottom line number of what's called effective gross income. So your effective gross is the actual money you bring in, all right? So that's critical. Know what that is. And it's really easy to overlook this. Once you start getting into a transaction, you get a contract, you're excited, you're trying to get the loan, you're dancing around, you're doing all this. It's easy to overlook things like this.
Don't get caught up in the market high.
Exactly. You know, exactly. You gotta focus, guys. You gotta focus. And I've been victim of this as well in the past, and that's why I'm so intent on really kind of driving that into you guys, is because it's easy to look at the projections and say, okay, well, we can get this, we can get this. You gotta look at what's real, and then build. You want to have your projections, but you're evaluating off reality. All right. Now, after we have our income, the next step, right, is the expenses. And what I should say is, these are operating expenses. So these are expenses that do not include the mortgage, right? So the mortgage is what's called debt service. That's the cost of the money that you use to acquire the property. That is not the cost of operating the property. The operating expenses are going to be things like taxes, insurance, management, maintenance, utilities, repairs, reserves. These are the typical ones. Also, things that we see pretty common are pest control, lawn care, you name it. Anything that pops up miscellaneous within the property that it costs to operate. You're going to have these. There may be more. So again, you're able to identify that by looking at the existing profit and loss statement. And you can look for somebody, if you're looking at a property and you think there's some discrepancies, ask for the person's Schedule C from their tax returns. Schedule C, sorry about that. E, like everything. And they'll get you, that'll show you what they sent to Uncle Sam, which is usually somewhere, it's either going to be lower or it's going to be the truth, right? So they're trying to, they're reduce their taxes, so maybe their income will be a little bit lower than reality. But so then you can use that and say, well, here's what's on your taxes. So it's a way for you to evaluate what's really going on, what they're really spending. Look, when you take over a property, your expenses are going to be different from the old owners, but you need to have a base to deal with, and you should try to cut some expenses if you can. But just know that it's going to be a little bit different, but you got to get as much ammunition as you can and much knowledge about that property before you actually close on it. So you got your income, and then you got your expenses. So what do? You take your expenses from your income, right? Simple math. That's going to get you to your net operating income. Your net operating income is the true value of the property, right? So what this means is the income after all the non-debt service expenses are paid, right? So I mean, debt service is mortgage. So this is after you pay all the expenses we just talked about. This is your net operating income. For commercial and investment property, anything 5 units and above for multifamily, and anything office, retail, apartments, office, retail, hospitality, whatever, the key determinant to the value of that property is going to be the net operating income. Okay, there's a measure called the capitalization rate that you apply to the net operating income that gets you a value. But this is the key determinant to that value. So you need to be able to identify what that is very, very clearly, because that's the lifeblood of what we're doing. Here's the key, and sometimes it takes a little while to understand. This does not include the mortgage payment. This is the money you use to pay the mortgage. That's why that's important, right? Don't mistake it, because this is the money you need to pay the mortgage and hopefully pay yourself. Critical, critical, critical. All right. That being said, the capitalization rate. Now, has anybody heard capitalization rate before? A couple of you got it. It's just a measure of value, and it's an instrument to measure value. Simply put, and in the CCIM stands for Certified Commercial Investment Member. It's a designation for commercial real estate, but more than that, it's a series of educational programs or classes, if you will, that educate you on commercial real estate investment property. This isn't the official version or the definition of capitalization rate, but it's my way of trying to make it simple. So basically, the cap rate is the rate of return, right, generated by a piece of real estate or real estate investment property based on the annual net operating income that the property generates. So basically, it represents the percentage return you would get from a building if you paid cash and you did not have a mortgage payment, okay? The percentage rate of return that you get from a building if you paid cash and did not have a mortgage payment. And what we're talking about here when we're talking about rate of return or percentage, It's the income. That's why the net operating income is very, very important. Okay, so the cap rate equals the NOI divided by the purchase price. All right. It took me almost a couple of years really to really understand this. So this is a basic way. Let me give you all an example that'll help you kind of understand this. It's real simple, real basic. Okay, so we're talking about the cap rate being a percentage of return if we pay cash for a building. Let's just say there's a building out there for $1 million, right? We go out, we acquire the property for $1 million. The net operating income of that property is $100,000, right? So that means after you collected, that's probably about $200,000. You paid out another $100,000, right? So your net's $100,000. Remember, you got $1 million. You know, got a cousin that played for the Heat, or you won the lottery or something. You're rolling with $1 million. So you paid cash. You don't have a mortgage payment. So that $100,000 is right in your pocket, right? That's your return, right? So that number represents 10%. That's $100,000 is 10% on $1 million, right? So the cap rate for that building is a 10% cap rate, right? $100,000 on $1 million, 10%, right? So in reality, I won't say reality because there's a lot of cash transactions going on. Most likely, there's going to be a mortgage payment, right? So the $100,000 is going to cover that mortgage payment. There's going to be something left over. That's going to be the money you put in your pocket. But just know this: when you're talking about capitalization rate, pretend there's not a mortgage payment. So that what you're looking at is the measure of return, that percentage rate of return if you pay cash for the building, right? That's a basic way to understand cap rate. And that's how commercial properties are valued. And here's a rule of thumb. It's the inverse for stocks. It's the same thing, but it's just inverse. It's the inverse measure as it is stocks, right? When you buy stocks, you're going to buy high and sell low. Well, from a cap rate standpoint, you want to buy high, or the higher the better when you buy, the lower the better when you sell, right? So if you bought this building, right, let's just say for $1 million, $100,000 net operating income at the current market, that's a 10% cap rate. Let's just say the market shot up, right? 5 years from now, the average cap rate people are willing to pay is 5%. Let's just say the market shot up, real estate's going crazy. So if somebody wanted to make a 5% return on their money, right? That's what the market dictates. That $100,000 NOI was still the same. What would they pay you for your building?
$2 million.
Exactly. Right? So you double the value of your property by things going up.
That's the best way to explain it before.
Yeah.
That's the best way to explain it ever.
Well, I try to make it simple. I think that makes some sense. Because, Kelsey.
What's the average cap rate right now?
Great question. Great question.
Can you repeat it before you answer?
Kelsey wants to know what's the average cap rate in the area today. It's an excellent question. And there's a couple different answers because it depends on what area, right? Okay, so here we are downtown. And did you guys notice the building next door? I know some of you guys may have come in here, but if you've seen this apartment building next door, it's a 31-unit building. They just purchased it for 3.9 and some change. They bought that one at a 5.78% cap rate, something like that was on the closing number. That's a little low for this area, downtown. That's more like the lake. By the Lake Merritt, you see 5 cap rates pretty much all day long. That's normal, 5, 6 is normal. Here by the downtown, somewhere between 6 and 7 is pretty much the norm. This building is unique, right? The reason why this building is unique next door is because it was built in 1991. So there's a rent control exemption. That means the landlord can come in there and jack the rents up immediately, right?
When did the rent control exemption start in Oakland?
Don't quote me on this.
Yeah.
I want to say 87 or 88. It's Barbara's
Yeah, just about that.
about 87, 88. Anything built in 90s, 90 or up, you're good. So this building next door, built in 91, right? So they're exempt from rent control. They're getting, now it's 28, I think it's 28 2 bedrooms, 3, or 28 2 bedrooms, 2 3 bedrooms, and 1 commercial space. They're getting like $1,100 for 2 bedrooms. Well, in East Oakland, on 78th and Bancroft, we manage a building, we're getting $1,100. You know, and you got, you know, there's homicides, there's, you know, and all that, it's, you know, 78th and Bancroft. So this is downtown, and you're sitting there saying, you know, the guy across the street with this, he's right here at the end of 24th, he's getting $1,500 for 1 bedroom. So the people who bought that, they bought it at a 5 cap rate going in. That was the actual cap rate because they knew that their rents were about $500 under the market. So just imagine a $500 increase on 30 units, right? That's pretty attractive. I think it's like $15,000 potential growth in income. So they bought that under the market, you know, and really kind of what we thought was overpaying my clients. Unfortunately, my clients offered 3.8, and they were $100,000 off. I told them they probably pay that extra $100,000, but they didn't want to because they felt the cap rate was too low. Right? Going in, it was only 5-something%. Oh, it's too low. Let's negotiate them. They didn't see what these guys saw. Is that, well, geez, we can jack the rents up immediately, $500 once we go in. Now, and they came in, they've owned it for like 2 months. They've completely tore out all the siding, put new siding, it looks like a new building. So I'm sure they're going to start jacking those rents up any minute. So just giving you that story because it kind of depends on the neighborhood. And it also depends on the property. Each property is a little bit different in and of itself, right? So that property was a unique property because it was rent control exempt. And the rents were about $400 or $500 under the market. So the guys were willing to pay a little bit less or a little bit more than market value because they saw the upside potential because the property itself had it built in because of the situation. So in general, 5 to 6% in the lake in the high-end areas, 6 to 7% in Oakland in the middle areas, and anywhere from 7 to 10% in East and West Oakland, in the tough areas, you know. Although, I did just see a property on High Street. Any of you know Link Corkery? He's a top apartment broker, been around for a long time. He's selling a building at a 5.5% cap rate on High Street. Now the building is all renovated, has all the bells and whistles, solar panel system. So you don't really see that in East Oakland that much, but it did just happen. But typically in East Oakland, somewhere between 7 and 10%. So it varies on the neighborhood, the property, the situation. Yeah.
Steve,
Yeah.
will that, for example, that property on High Street,
Yeah.
he's selling it at a 5%, would that dictate other properties in that same area to change?
Well, it's going to be a comp, right?
Okay, right.
So when for commercial property, you look at apartments, you're going to look at the price per unit. Retail office, you're going to look at the price per square foot, stuff like that. But you're also going to look at what is the cap rate on those comps, right? So when that property closes, it'll be a cap, it'll be a comp.
Right.
So when people go and look at it, I say, wow, 5% in East Oakland. So that's going to affect values. That means probably cap rates might, drop a little bit over there. Now we got interest rates going up, but that's a whole other conversation. But just in general, as it relates to that comp, yeah, that's going to affect the surrounding property. So other property owners are going to think they can get something similar.
But that's not necessarily true.
Not necessarily, right? Because that building has a complete solar system. There's no PG&E bill at all.
The appraisal would adjust down for all of that.
Right. Now, I don't know, solar is another conversation. That's real popular. I'm actually I want to learn a lot more. That building doesn't have a PG&E bill. That's pretty nice. So I don't know how that works, but the guy set it up, and he probably paid a pretty penny to set it up. But he's able to get it back because the prices that we're selling his property at.
Yeah, I mean, because what that sounds like, the solar sounds like to me, and what the exemption sounds like to me is an impact on the NOI. You're
Right.
projecting
Right.
a higher NOI, so in effect, it's going to change the equation, right?
It's going to change. You should have a higher income if you're not
Right.
If you're not paying.
Because the solars may be paying you back. You might be getting an income from
He might
the
be
solar.
getting into that's a good point. That's
Yeah,
a real good point. But it definitely affects the income, it affects the value, and it's a direct comp. So it's things you want to look out for. So I know time is ticking, so I'm going to move on. Other terms that we're looking at is net cash flow, and this is important because that's the money you put in your pocket, right? You need that, and you want to have that, and you want to budget for that. Net cash flow cash on cash return, we talked about this before, to break it down, it's basically the net cash flow, the money you put in your pocket, divide that by the total of cash invested. So that's your down payment plus your closing costs, right? So if you buy a property, there's a down payment, but then there's, cost of the loan, transfer tax, all of that. So that's your initial investment or your total cash invested. So that's critical because those are the measure, that's gonna dictate your measure of return, your cash on cash return. You take your down payment and divide that, right, by the total cash, take your net cash flow, divide that by the total cash invested, and that's gonna get your cash on cash return. The stuff we're looking at, we trying to get at least 10% and above. That's gonna become more and more difficult to get with the market kind of rolling up like it is. So, just be aware of that. You put together your own requirement for your rates of return. We try to get 10% above. Internal rate of return, I'm not gonna spend too much time on this, but basically it's the total return on the initial investment on an annual basis once the property is sold. And that's kind of, again, not the official definition, but look at it like this. Cash flow is one element of return. Every month you make a payment, that's just interest only, you're paying down the mortgage. That's another element of return. If the property grew in value or grew in income or dropped in income, that's another element of return. And then also the tax impact. Either you're gonna have a tax bill or you're gonna get a tax break. So that's gonna affect the rate of return. And so that's how you calculate the internal rate of return. It's the overall picture based on the life of the deal. So you have to have a time period in which you own it or you project to own it, right? In order to calculate your IRR, internal rate of return. It's more of an institutional measure, but I think the small investors should know about it as well. And if you can actually outperform the institutional or the big boys by just having a solid system and knowing what you're doing, right? So just because you ain't shut out 100, 200 million doesn't mean your rates of return may be double those guys, right?
So, Steve, do you care about your rate of return if it's less than a year, and how do you?
Yeah, well, good question. And that's, if it's less than a year, you're probably looking at a flip, right? Mm-hmm. So flips are categorized different than investments from taxes, first and foremost from a tax standpoint, but then also from kind of an investment outlook. Rate of return on a flip is always important, right? Okay. But it's just looked at differently, and you want to make sure if you're flipping, you gotta get a higher rate of return than 10%. You should get a higher rate of return, unless you're investing with a flipper, in which case you're just giving them the money and letting them do all the hard work and say, give me 10, 20%, or whatever, I'm good. But if you're out there putting up the money and you're doing the work, you should get more than 10%. You probably want to get 40 to 50% at least, if not double your money, right? If you're flipping. So just another category, another element of what's going on. Pricing, and then here's on flips real quick. If you're flipping, you want to kind of have a 25% profit margin or more. That means when the cost of what you bought, the cost of capital, that means your interest, right? The holding costs, if there is any in addition to interest payments, the whole cost of the project, commissions, you have to pay your realtor to sell the property, right? Okay, all of that should not be more than 75% of the price.
Plus taxes.
Thank you. Thank you, Matthews, because you're gonna have to pay taxes when you flip, right? And and not capital gains, ordinary income. I talked to your accountant, but your capital gains taxes are on investments, right? So when you're flipping, you're dealing, you're not investing. It's just a different category. So you're gonna get hit probably a little bit harder on a flip. Your tax rate's gonna be probably a little bit higher. But that's on your own individual tax situation. Talk to your planner, your CPA on that end. But budget for it. And just don't flip just to, I got it low, I'm sorry. You gotta look at all the costs, and you want to budget for 25% profit because things go wrong and you want to make money. Make sense? Okay, I'm gonna blast through these strategies and then talk about offers. And which I think is really critical. So I got two main categories: buying individually and then buying together, or buying as a group. Buying individually, right? There's couple bullet points, of what you can do individually. REO short sales, distressed properties. REO and short sales are starting to dry up, especially REO. Short sales are still out there. You guys know the difference between REO and short sale for the most part? Okay, so I'm gonna go in there. Note acquisition, loan to own strategy. Anybody heard of this before? Very effective strategy on how you can acquire a property. Now it's just gonna be difficult for residential, right? So like a fourplex, this may be difficult unless the loan is a hard money loan. The hard money loan, you can buy it. If it's a loan from Bank of America, you're gonna have a tough time buying it because they're gonna sell that loan with 100 other loans to BlackRock, some major private equity group, right? They're not gonna sell it to you. The hard money guy might just sell it to you. Now, once you go 5+, then, so 5+ units or any commercial property, then the bank is willing to sell that note off individually. So it's a little bit of a complex strategy, but if you can buy that loan at a discount, you become the bank, right? In essence, what you have to do is finish off the foreclosure. That means hiring a receiver. In commercial property, banks or lenders typically will hire a receiver to enforce the assignment of rents clause. In each commercial loan, and I've never seen a commercial loan that I've done that did not include what's called the assignment of rents clause. This is what this means. If you start making mortgage payments on a commercial property, the bank can come in and take over your property and start collecting rent before they foreclose. Understand? Before they foreclose. It's called receivership. So they go down to the county, they file something, they hire a receiver, and they knock on your door and say, hey man, you got to get out of here. We're collecting the rent now. And you're like, wait a minute, hold on, you haven't foreclosed. Well, there's what's called an assignment of rents clause in the note that they can start pulling in money before they foreclose, right? So that's, a lot of people don't know that. For commercial property, they can do that. And now, if you become the big bad bank, you can do that too. So, right, just know that that's possible. And then if you finish off the foreclosure, you can flip the property as an REO, or you can hold it and own it at an extreme discount. A lot of sophisticated investors are using this strategy right now. You gotta know what you're doing. And you also have a really good attorney. If someone can file bankruptcy, or they get, you can do things improperly. So know what you're doing. Buying, holding for cash flows, kind of more of a, I don't know if that's a strategy, that's more of a plan, if you will. Buying and flipping, same thing. Buying, holding, and exchanging is a real good strategy. You can get into a property, a single family house with minimal money down, right? Buy the property, a couple of years go by, sell the property, that money you put down may have grown substantially, and now that money you used to buy a single family house could potentially put you into an apartment complex or a 4-unit. But either way it goes, you're able to expand your equity or increase double or triple your equity many times by basically selling the property, taking the proceeds, and moving it up to the next one, okay? Very, very shrewd strategy. There's some laws and rules that go along with it, but no, 1031 exchanging is a real popular strategy that's coming back today, and it's a great way to increase your wealth in a short period of time, all right?
What is because that's kind of what I'm considering for some stuff. What's the term, what are the sort of the timelines with regards to that?
Good question. Okay, in general, what I would say, before I say this is a disclaimer. I'm not
People licensed tax professional.
talk to, IPX 1031 Exchange, Chicago Deferred Exchange.
Not so much about 1031. I'm
Right.
more of like just the general strategy goals.
But on that note, even for a specific 1031, you're gonna have 45 days. So once you close your downlit property, that's the property you sold, right?
So I wasn't asking about 1031s.
Okay.
I was asking more about the timeline for buying it, how long do you hold it to make it a good ROI, exchange, what's kind of the business plan behind it, that's all. Yeah.
Well, I would say a good timeline typically, and it kind of depends, right?
Of course.
But I think in general, like 2 to 3 years is a good time. Now, from a tax standpoint, that's a good question because it's a gray zone. There's no rule that says you have to own the property for so long, right? A rule of thumb is you want to have at least one tax year. So if you've held the property, you filed taxes,
Through one tax year.
you've shown that you're owning the property for the purpose of receiving the income, right? You're not dealing with the property, you're not flipping it. 'Cause that's
Now,
where
are
you're
you,
looking for.
one question, are you buying it as an owner occupied or as a rental property?
Rental.
Right.
Multifamily.
Yeah, so you're good. And it could be anything. It could be raw land, the product type could be whatever. But what he says is important. Rental property, income property. So owner occupied, you can't do it, right? But if it's income property, at least one tax year, you want to have it. Now, when you go to sell, you got 45 days from the time you sell your property to identify a new property, but then you also have 180 days to close on it. So you got time, but it's good to know. And then from the time you buy something to move up, it's at least one tax year. My accountant says 2, to be safe. But at least if you're able to demonstrate that you're owning the property for the purpose of income, you should be okay.
Okay.
Yeah, okay, so that being said, let's move on. Talk about co-investing with partners or sponsors. This is where the topic of syndications come in. So I'm not going to go into details about properties. Sometimes I'll talk about properties because there's some gray zones as it relates to SEC, all right, and syndications. I'm not going to go into like details about rates of return and properties that we're working on. We can talk, and we've got a few deals that we're working on. They're really good. We can talk about it. But the basic principle is when 2 or more people come together to acquire property that they would not be able to acquire individually. All right. So you 3 get together and say, hey, we want to go buy a 10-unit building. Maybe we can't do this all individually, but we can put our money together and then we can go out and acquire a building. Right. There's some pros and cons that come along with that. Some of the pros are, hey, you wouldn't be able to go and do that by yourself, but you go with the group and now you can take it down. Some of the cons is you're in the group. So, right, the same pros is a con sometimes. So, and there's different nuances. But the bottom line is it's becoming very popular right now. And we're seeing a lot of cash offers, right? Because people are putting their money together. And there's probably, I'll give you an example. A property in North Oakland, the mixed-use duplex that we're selling, we got 5 offers. 3 of the offers were from groups. And when the offers came in, and it was, a couple different names on the offer, where it was a group of people paying cash because they put their 100. One guy puts 100, somebody else puts 100. Another person, they have the skill to put it together or to do the rehab work. It's a way to accomplish things that you wouldn't be able to do individually, and it's something that as a company, Infinity Investments, we're really trying to build that as our core business model. You have to be careful because of the legalities around it, but it's really what we want to kind of morph into. So that's why I'm learning as much as I can about the subject. We're doing it on a small level, hoping to do it on a larger level. Something that you can do on your own as well, or something that you can do with friends, family, close associates. Just look at it as a way to be able to acquire property that you wouldn't be able to necessarily do individually. Because if you can do it individually, go ahead and do it individually. Do it, and up until the point where you need to go get partners. If you have $2 million in your bank account, you can only buy so much real estate, right? That gets you somewhere. But at the end of the day, you only buy so much, right? So don't let that stop you. If you need to go out and raise money, figure out the way to do it. Talk to us about it. If you have a project that you're looking to raise capital for, we may be able to help. If you're looking to put capital into a deal, we may be able to help. What I would suggest is let's schedule a time, sit down and talk about it, see how we can do this, right? That being said, that's the end of the presentation. I want to spend, what time we got, Matthew?
Right now, we have 8:11.
Okay, perfect. So I want to get you guys out by 8:15. We're going to go a little bit over that, but we're definitely out by 8:30. Promise. All right, so now let's just talk about getting your offers accepted, all right? Show of hands, how many people have been outbid this year?
Or clients.
All right, same thing, all right, right?
Like duh.
You know what I mean? Everybody's, right? So give me some feedback, guys. What were some of the reasons, not reasons, what did you guys hear from the agent, or did you hear? Well, a lot of times the agent won't call you back. But if you heard from the agent, what did the agent say when they called you?
All cash close in 20 days, or 15 days.
Right, right.
Over asking.
Over asking.
Yeah, they were getting much more money than I thought reasonable.
Yeah.
I would not have wanted it
Yep.
at that price.
Same experience.
Yeah, yeah, that's
10-15% over asking price. Those numbers don't make sense.
right,
No, they didn't crack, but
right. But they're out there,
right out
right?
there.
You know, and it's probably been a year and a half, almost 2 years that I've been seeing this. 2011, I didn't really see too much overbidding on stuff. Really kind of start last year, right? But this year it's really gotten out of control. So it becomes discouraging at times, right? As brokers, we get paid on closing deals. As investors, we get paid on bringing in income or flipping properties, right? So when you don't have closings, that affects things, right? So you got to get a little bit creative, right? So a couple of things that I want to talk about that I think can help the odds of your offer getting accepted. The first thing I think is an overriding principle, right? It's not any particular strategy, but I think being a good person, I know it's a little cliche, but it's really, really important. Being well-liked, having a good reputation, right? Either as an investor or as a broker, really, really critical. Listing agents, right, and especially now is the time where listing agents are getting cocky again. You know, it might have been 2005, 2006, where listing agents, you would never talk to a listing agent, you talk to their assistant's assistant, right? You know, Michael, I worked at Sotheby's, Mike Hardy, you didn't really talk to Mike Hardy, you talked to his assistant's assistant, you know what I mean? And he had 40 REOs, that's why. Not because he was an a-hole, but because he had 40 listings, right? So, you know, he wasn't talking to you. I mean, a lot of guys, the same thing. So, if he's got 20 offers and they're all above asking, and okay, who's he gonna go with? Is he gonna go with somebody he doesn't know, or is he gonna go with somebody he knows? First of all, probably somebody he knows,
Yes.
right? So, networking, building up your name, building your reputation.